All right, we have got Serena Flowers joining us now. She is an attorney and partner with consultants at Jackson and also president of Avant-garde Strategy. Serena, thanks for coming in.
Thank you, Gerard. Nice break from the heat to come inside this afternoon.
It's pretty cool in here, honestly. Sometimes I actually have to dial down that air conditioning a bit in here. They get it cranked up. Rhino likes it really freezing cold in here, but we wanted to have you in the studio today to talk to us about the employee retention tax credit. This is something that's not terribly old. I think first version was introduced, passed into law in the CARES Act, if I'm not mistaken, right?
That
in 2020, signed by President Trump. And it's one of those things that's a bit obscure that a lot of people don't know about, but there's money out there for the taking. So tell us first, just give us a brief overview of exactly what this tax credit is.
So initially in the CARES Act, there were two programs that businesses could take advantage of, and it was the PPP program, which most businesses were drawn to because of the ease of the application process, and they worked with the local bank through that. The other program was called the Employee Retention Tax Credit, and at the time, it was a true tax credit going forward. But seeing that not many businesses were taking advantage of this, President Trump, when he left office in 2021, signed an executive order that said that businesses could also be eligible for this employee retention tax credit, even if they took PPP money. Now, again, they were trying to reward companies, nonprofits and for-profit businesses, for keeping people employed during the pandemic. So the way that the program works now is it is a reflective look back of the last 2 quarters of 2020 and the first 3 quarters of 2021 and the W-2 earners that were employed during that time.
Okay.
So process-wise, you look at, there's a formula that the firm uses to analyze an application for a business. And again, I'd like to reiterate that it's for-profit businesses and nonprofit businesses as well. Mm-hmm. So there's the formula that we use, and you look at the W-2 wages that were earned during that time, the employment taxes paid, fringe benefits paid, whether or not you receive PP funds. Now, that will play a role in the amount that you receive in the credit. And let me pause here and say it is called the Employee Retention Tax Credit Program, but the money comes back to you in the form of a tax refund.
Okay. So it's a payment? It comes back to you? Do you have to wait till you file your tax return, or do they approve your application for it?
No, that is part of the service that we perform.
Okay.
We work with a business and we collect their financial information, and then we talk them through some of the subjective things that their business experienced during COVID to determine their eligibility. Once we determine they're eligible, then we run their numbers through our analytical program. There's a proprietary software system that a local tax firm and a local IP firm here in town developed. And the tax firm that we work with on this project is Dallas, Anthony, and Jeffords. They're located in Flowood. And the IP firm that developed the proprietary software system is the Fresconia firm here in town.
Interesting. Okay. Yes. So essentially someone who is a business who thinks they might be eligible for this, is interested in it, you guys collect their information, run it through the analytical software, and then it basically says yes or no, I assume, that you qualify, and here's how much you qualify for.
That's exactly correct. And then we put together a package for the client to review and send it to the IRS. Initially, when these packets were going to the IRS, it was taking about 6 to 9 months for the IRS to process the application and submit the refund back to the client. But we have seen recently they have sped up their process. And I would like, it's probably a little funny side note here, but we saw some correspondence from some members of Congress to the IRS saying, hey, this program was passed to help the people recover in the pandemic, and y'all are taking far too long. And so they've apparently upped their manpower, because now we're seeing clients get their refund back in about 4 months.
Interesting. So qualification in terms of dollars could be as much as 70%, right, of qualified wages?
Yes.
For a quarter, right?
That's correct. A hard figure for a maximum rebate per employee is $26,000.
Okay.
That would be $5,000 for 2020 and $21,000 for 2021.
Okay, so explain that to us, Serena. So there's a time period that this applies to, and even though we're way past that, you're actually filing for these credits for that time period, in arrears, essentially.
That's correct. We look at the last 2 quarters of 2020 and the first 3 quarters of 2021, to determine eligibility.
Okay.
And let me throw out here, too, in 2020, you had to have had fewer than 100 employees to be eligible, and they raised that number to 500 for 2021.
Right. That's right. So, yeah, that's right. It started out at 100, and that there's adjustments made. So I believe I stated that accurately. It started out as a program in the CARES Act, and then in one of the continuing resolution appropriations bill, I think of 21, it got extended and maybe some small changes made to it. And then the American Rescue Plan that Joe Biden signed in March of 2021, that extended it further, I believe, and added some enhancements.
It raised the amount eligible
from 50 to 70.
Yes, that's correct.
And then the 500 employees threshold.
That's correct,
yeah.
which allowed it to, would qualify more businesses across the country.
Yeah. So I think the big message here, Serena, correct me if I'm wrong, is that a lot of people just don't know about this that do qualify for it, and this is money, their tax money that they can get back.
Yeah, so initially when you take a first glance at this, there are two tests to determine eligibility. One is the revenue reduction test, and the other is called the nominal business impact test.
Okay.
We're seeing across the board as we work with clients that working with their individual CPAs, the CPAs tend to focus on the revenue reduction test, and that disqualifies a lot of folks because, there were some businesses that actually increased their revenues during the pandemic.
And let me interrupt right there. So really what we're talking about there is that it's a calculation that compares your 2019 revenue, the corresponding quarter in the period that you're applying for, 20 or part of 21, and if you show a decline in revenue, I don't remember what the threshold is. I think that changed a couple of times too.
Several times.
But bottom line is, if COVID knocked down your revenue because you had the government shutting people down, but you were able to maintain your employees to a certain extent, they want to reward you for that. That was the I think the catalyst for the legislation, and if you can prove that with financial statements, then you're qualified, essentially.
Yes, that's one way to qualify.
Okay.
The second way that you can qualify is called the nominal business impact test.
Okay.
And that's rather subjective, and it looks at things during the pandemic and how your business operated during that time.
Okay.
Whether or not you were subject to full or partial shutdown, if you had supply chain issues, if you had to rework your hours for your operations because either your employees had COVID and couldn't come on the job, or you had to restrict the number of people in your facility, if you had problems with your vendors getting supplies or your vendors calling on you, if you were not able to attend networking events, there's
some
probably
safe
10 or
harbors
12.
basically.
Yes.
So what would you recommend, Serena? So there's people that are listening right now that may think, geez, I didn't know about that, and maybe my business qualifies. They really just need to check it out, right?
That's correct.
You guys would help them with that.
I highly encourage all nonprofits and for-profits to look into this. Again, we have a seamless process that we've developed here in the three firms working together.
Okay.
To learn more about it, you can go to ertc.flowerslawoffice.com.
Okay.
And there's some general information on there. And whether or not you use us or someone else, I highly recommend all businesses to take a look at this.
Okay. Yeah, again, it's money out there that's ripe for the picking, honestly. And I'm also pleased to hear that some senators put a little pressure on the IRS to get them to speed up the process, because if you truly did incur these additional expenses or certainly revenue losses as a result of the pandemic shutdowns, well, the government, in my view, is obliged to compensate you for that, and that's really what this is designed to do, as much as anything.
And there's also some talk right now in D.C. about expanding it to the fourth quarter of 2021. That has not come to fruition yet, but there has been some discussions to expand that fourth quarter as a qualifying quarter as well. If that is the case and you've already applied for the ERTC, pay attention to that, because you can go back and add that fourth quarter.
Okay. Are ERTC payments, are they taxable? Is there any other further obligations on the part of the recipient?
So there's two schools of thought on that. One is you go back and amend your prior returns.
Okay.
And two is that you treat it as taxable income in the year that you receive it. And deal with it.
So you
going
have a
forward.
choice
That's
in that
correct.
case? Okay. So would that affect their 941 reporting as well?
And so the good question. The ultimate filing in this application is a 941X.
Oh, okay.
It's an amended 941.
That makes sense. Yeah, that makes total sense. Yeah, not reinventing the wheel there. Serena, thanks for coming on. That was great. Appreciate the explanation.
Thank you.
Serena Flowers talking about the employee retention tax